Hello everyone, welcome to Kotak Wealth's market update for August. I'm Asharya Das and with me is Shobit Mathur. Hi Shobit.
Hi, Ausharya.
Let's start with equities. With the Nifty being almost at 11,700, where do we see markets from here?
So, of course, these are all-time highs, and it does require one to be cautious on markets. If you look at pure valuations, we are now in that 19 time to 20 time kind of forward earning ranges. This is, of course, built on the expectation that we are going to see a 20% kind of an earning growth for next year and possibly the year forward. But having said that, I think there are quite a few concerns globally, and few of the upcoming events regards elections in the next 6 odd months, that we sort of are taking a call to be slightly underweight on markets. The way we are looking at things is that US is going through a phase of growth, but lead indicators in terms of interest rates are showing some signs of slowdown. We also had an event where Turkish lira has seen a significant amount of beating given their deficit issues. And of course, all of that had an impact on Indian currencies as well, and we have now seen rupee touch 71 in recent times. So to that extent, macro continues to be under a bit of a pressure. And given the fact that we have elections coming up very soon in India, we are trying to be a little cautious and asking clients to be 10% underweight on their equity positions.
So, given the current market outlook and given the fact that most portfolios are underperforming the broader index and we've given an underweight call, how do you position portfolios from here?
So interestingly, this rally has always been in the last 6 months, the concentration restricted to the few large cap top 5-7 companies. In light of that, of course, the way the underlying portfolios have also positioned themselves is that they have played a catch-on game when, say, names like Reliance, TCS, Infosys started to move up either because of their underlying expectations or currency movements. The underlying managers have just trailed those kind of movements, and to that extent the underperformance in the phase of the last 6 months has rightfully been there. But having said that, I think eventually earnings will start to make their meaning felt in portfolios, and to that extent we are not concerned about underperformance for a longer period of time. Having said that, on the portfolios, the way we think we should be positioned right now, given the risk that I spoke about earlier, I think we want to be large cap biased as far as possible. We want to be slightly cautious on portfolios as far as possible. And we do think that next 6 months will see signs of volatility, and to that extent one can possibly even look to stagger their investments so that they can take advantage of some of those volatilities in the upcoming period.
Are there any high conviction strategies that we are recommending to investors?
So we've been talking about the banking and financial services theme to a large extent, which is riding on the underlying themes of private sector banks, which are gaining ground from public sector banks, insurance companies, which are only going to see further increase in penetration, and financial services companies, which would include exchanges, rating agencies, asset management companies, which are effectively gaining ground because of the financial savings theme which is playing in this country. On the other side, we are also seeing consumption as one of the key themes which people should focus on. The underlying reasons for that are threefold. You are seeing increasing amount of urbanization which is happening, which is leading to more and more people moving to tier 1, tier 2, tier 3 towns. You're also seeing nuclearization of families, which is leaving more money in the hands of individuals to spend on their families, and that's leading to higher consumption. We are also seeing significant traction because of what's happening on the rural side, where MSP prices have gone up, and to that extent there is more money available in the hands of rural economy to spend on consumption items. Also, I think the third thing which we need to focus on in that piece is the housing and electrification part, where what is leading to is that there is more and more penetration and reach of electrification, and there is requirement of the housing sector where there is building construction material which is going to get positively impacted by the government policies. So yes, I think housing to that extent is important, and banking and financial services and consumption remains one of the key themes that we would recommend investors at current moment.
So if I was to sum it up, we are talking of a 10% underweight call, we are talking for large cap bias, and we are also talking of some high conviction managed strategies.
Yes, I think that would be the right way to look at equities.
Moving on to debt, with RBI maintaining a very cautious stand in the last policy, what would be our outlook on interest rates, inflation, and the currency going forward?
So we of course have talked about the weak global macro and weak Indian macro to some extent in the past. Rupee breaching 71, of course, on a headline number creates some bit of concern for most investors. Having said that, I must highlight the fact that this time we are no longer in a similar situation that we were in when we last time had a currency crisis in 2013, largely because of the fact that our reserves are on a much stronger wicket. You have an RBI which has been very, very cautious about how interest rates should try to control inflation. And on fiscal deficit numbers, we last time had a overshoot on all counts. This time I think government is trying to keep those numbers relatively in check. Of course, it's an election year, so one needs to be cautious and watchful eye has to be kept on how interest rates and inflation behave going forward. But as of now, it looks like that RBI is maintaining a cautious stand and they will watch inflation very closely. They might need to do one more rate hike if they see effect of crude oil prices and currency. But looks like that this will be a very wait and watch kind of a stand that RBI will take, and we'll have to accordingly make strategies going forward.
In the light of what you just mentioned, what would be our debt recommendations to our investors?
So we still do not find our thoughts to give any long-term interest rate views to investors. We continue to think that we are in a phase where RBI will wait and watch and interest rates can be a little volatile. To some extent, interest rates have gone up quite significantly. So what we are recommending investors to do is prefer a buy and hold strategy across various horizons. One could look at fixed maturity plans, open-ended funds, and look to bucket their investments between 1 year, 3 year, 5 year, 10 year segments. And I think there are a lot of options available across different time buckets for one to just buy and hold their strategies for different time periods. One more point that we think one should consider is that today AAA and AA kind of papers are giving quite significant returns. So one can construct good quality portfolios and still achieve the desired returns across some of these strategies that I spoke about.
Thanks, Shobhat. I think we've covered most of what was relevant.
Thanks, Ausharya.
Thank you all for joining us. I hope you found the discussion interesting. If there are any queries, please do write into us, and we look forward to seeing you next month.